Welcome to Within the Frame, where we bring the most pressing issues across the globe into focus. I'm Kim Mok-yeon. As the year 2025 nears its end, Korea's economy is facing a convergence of pressures. Currently, currency instability, inflation uncertainty, and shifting trade dynamics. The won is weakening again, raising alarms beyond the financial markets. But this isn't just about numbers. It's about perception, timing, and policy decisions that could ripple far beyond the year end. In the United States, macro signals are sending mixed messages, while global markets are beginning to question whether the AI rally is sustainable. And with new trade shifts taking shape from Europe to North Africa, Korea's position in the global supply chain is once again being tested. So how should we read the moment we're actually in? For more on this, we connect to Kim Mok-yeon, professor at Seogang Business School. A big welcome.
Thanks for having me.
And also joining us is Bae Sung-ho, professor of business administration at Kyungbuk National University. Good to see you.
Good evening. Thank you for having me.
Right, so let's start a discussion with Professor Kim with the exchange rate first. So a couple of days ago, the won briefly broke 1480, the highest in 8 months, and it's now holding above 1470, and that's nearing a crisis-era levels. Professor, what's behind this sharp rise?
Okay, if you look at the numbers, 1,481 per dollar, like it's the number that we see in the 997 that we have a IMF financial crisis. But if you think about those kind of situation, well, there is a kind of global dollar strength, but in the Korean way, there is like an outflow of the won. Those are pressures, but I don't think it's not kind of just a one-time event. It's kind of very stable issues right now. So first of all, basically the dollar stay firm as U.S. economy grows and yields remain relatively strong. But on the other hand, like the investors, they're trying to, since dollar is very strong, they're trying to maintain the investment in the U.S. market in the dollars, but they're trying to become a seller in the Korean market. And indeed, well, basically, for the Korean situation, where we trying to make a lot of investment in abroad, basically, especially like MPS and our investors, well, they're trying to make investments with the U.S. market. So they spend up, they use a lot of dollars. So it's kind of like it's gonna make some impact. Lastly, well, basically the won is weak and dollar is very strong, and most large companies in Korea, well, basically they export the products and they own the dollars. But after they own the dollars, of course, they maintain the dollars in their cash flow. They don't want to exchange those dollars into Korean won because basically the market, like foreign exchange rate, is kind of very high. It's not. I mean, so. Well, those companies where they're trying to avoid those kind of risk in foreign exchange rate.
So all of these factors, they definitely put pressure on the policymakers going into the new year. Now, when we stay with the market movements, Korea's money supply in October hit a record of 4,470 trillion won, and some point to it as a reason for the weaker won, though the BOK strongly disagrees. Professor Bae, we wonder what's your opinion on that?
Yes, recently there's a growing concern in Korea about the sharp rise in the $1 exchange rate. And it's true that there are various opinions on the cause. Among them is the view that the increase in liquidity, specifically the sharp rise in M2 growth, has driven up the $1 rate. M2 has been growing around from 8% to 9% year on year since last summer, reaching roughly 4,480 trillion won in October, which is high relative to the Korea's sub 1% real growth. The Bank of Korea's main argument on this as follows. First, the pace of M2 growth is at an average level compared to past rate cut periods, so it's not excessive. Second, firms that were outside the M2 has flowed massively into M2 products like ETF beneficiary certificates. So there's a limit to viewing this as a fundamental increase in M2. The Bank of Korea argues that claims of excess liquidity driving house price surges and one weakness amount to overinterpretation, ignoring a range of key indicators. The Bank of Korea's statistical analysis and argument seem reasonable. However, statistics can always be used to support claims, so caution is needed. I still believe liquidity indicators remain important. Rapid M2 growth amplifies risk appetite and leveraging, which can indirectly weaken the currency by encouraging capital outflows and raising concerns about financial imbalances. High liquidity also limits the Bank of Korea's room to cut rates in response to weak growth, because losing further would risk asset price inflation and could deepen the perception that Korea is running an ultra-easy regime behind the weak one. Moreover, the Bank of Korea announced plans to revise its M2 compilation method to better reflect reality using international standards, which naturally shows lower liquidity post-change. I worry this metric overhaul might amplify market confusion or suspicion.
So with this situation, the thing important now is how the government would respond to this. It in fact has relaxed FX holding requirements for financial firms and is encouraging more foreign investment in Korean stocks. Professor Kim, do you think these measures would actually be quite helpful, and what else could be needed?
Well, the government is trying to do everything to, basically to make a lower, the higher one versus dollar value. But they're trying to do a lot of steps, but I think it's kind of like a fundamental issues that we have to solve. But I hope that it's going to work. First of all, they're trying to temporarily relax foreign exchange liquidity requirements so that banks, security firms, and insurers now face lighter supervisory pressure from the strength foreign exchange liquidity stress test until the end of June 2026. Basically, where they can deploy the part of their excess dollar holdings into the market. And second, basically, they have raised the forward foreign exchange position limit for foreign banks, subsidies from 75% of equity. The previous, the same domestic banks, they have up to 200%. While foreign banks branches keep their like a 375% capacity, they're gonna attract additional foreign currency into the Korea so that they can expand the supply of hedging ON dollar liquidity. And finally, it plans to allow the exporters to use foreign exchange loans not only for the facility investment, but also for domestic working capital. And then they can promote tools like omnibus equity accounts for the foreign investments. When firms borrow dollars and convert them into one for local use, they create the extra dollar selling using some depreciation pressures at the margin. Basically, what are they trying to do? They're trying to trying to attract more dollars into the Korean market so that we can ease on those kind of high foreign exchange rate. But I hope that like fundamental issues like have to be solved before like it's going to be working on those kind of other issues.
So more backup policies would be necessary moving forward. Now, over in the United States, after delays from the government shutdown, key macro indicators like job and inflation are finally out. Professor Bae, how would you assess the state of the American economy based on those figures?
Yes, the United States economy shows clear sign of cooling with weak job growth and rising unemployment in November's data. Through inflation ticked up modestly to 2.7% year-over-year amid data gaps from the government shutdown. These delayed reports highlights labor market softening but persistent price pressures, suggesting a bumpy slowdown rather than recession. According to the job reports, non-farm payroll rose by just 6,400 in November, below expectations, after distortions from federal buyout and the 43-day shutdown that skipped the full October data. Unemployment climbed to 4.6%, the highest since 2021, signaling hiring slowdowns across sectors. Regarding the CPI figures, headline CPI increased 2.7% annually through November, with the core at 2.6%. Monthly gains were partial due to the resumed survey post-shutdown. However, concerns persist that this report data is distorted. The main reason October's United States job data was skewed stems from a 43-day federal government shutdown that halted data collection and processing, plus early retirement of 160,000 Treasury staff reflected as massive job losses. Household surveys weren't conducted at all during the shutdown, likely leaving unemployment figures entirely missing. So, full trust in these numbers compared to prior data has clear limits. But the recent report shows weak job growth and rising unemployment, signaling a cooling labor market. Inflation above the Fed's 2% target will likely constrain late costs despite growth worries.
Mm-hmm. And now we're kind of curious how this latest data reveals what it actually reveals about the policy direction. Professor Kim, how might this actually shape the Fed's timing and pace for rate cuts?
Basically, well, they already cut the rate to 3.5% to 3.75% this month. But well, if you look at the inflation rate, it's kind of 2.7%, 2.7%. Basically, where their expectation was lower, basically. And they look at those kind of numbers, unemployment rate, 4.6%, and basically where they become very cautious. What are you going to do, especially for the next years? So, well, even though they get a lot of pressure from the Trump government, basically they have to lower the interest rate, but they are very cautious to look at all those numbers and the economic situation, especially for the future, for the next years. Well, what they say is that they're going to have some projection, and they're trying to cut the rate maybe once or 2026, and they're trying to see those kind of numbers, and their stance is neutral. But well, who knows that the U.S. economy is kind of going, which way they're going to go, positive side or like negative side. But I think they're very cautious to make a quick decision right now to make a bold prediction for the next years.
Mm-hmm. So this decision by the Fed, it's going to be a major variable heading into the first quarter of next year. Now, while we're talking about the United States, there's also growing chatter again about an AI bubble. Professor Bae, do you see this as a short-term sentiment or a sign of a deeper structural risk in the AI sector?
So I think this is a big question. Recent AI stock dips reflect more than fleeting sentiments. They signal structural risks in the sector, including sky-high valuations, massive unprofitable infrastructure spending, and overcapacity threats from uncertain demand forecast. While hype drives by the deep behavior, cracks like Oracle's debt woes and lender caution point to a potential bubble beyond the temporary pullbacks. We can find the sign of investors' sentiment dips. Sharp drops in leading AI stocks like Nvidia and SoftBank, over 10% each, along with waning retail investor buying frenzy are prime signals of this shift. The structural issues in AI persist too. Revenues stagnate outside the top players, and computing power models are monopolized by a handful of firms, creating extreme concentration. Recent chatter links the AI bubble to the dot-com era. AI and the dot-com bubble share overheated valuations and tech hype, but AI stands apart with revenue-generating firms, real demand, and infrastructure investment, unlike dot-com's unprofitable, fraud-driven collapse. dot-com wiped out 75% of stock and triggered the recession, while AI's dominance by giants like NVIDIA offers better shock absorptions. Cautiously speaking, AI isn't as vulnerable as dot-com, but capex overinvestment and energy constraint could bring 2026 adjustment risk. Fed rate cuts might trigger a temporary rebound after dips, yet ongoing profitability doubts and infrastructure imbalances suggest limited correction next year.
So, in contrary to these AI sectors, Korea's chip makers actually they seem to be moving in the opposite direction. Samsung and SK Hynix are expected to post record earnings. Professor Kim, what does that suggest about global demand and Korea's competitive position?
Basically, well, for this year's, I mean, the revenue for the Samsung and SK Hynix and the projection they're going to make in next year is basically we call it like a fantastic record. So even though like we're going to call it as an AI bubble, but well, the SK Hynix just posted record current revenue of 24.4 trillion won and operating profit of the 11.4 trillion in Q3 in 2025. And of course, the Samsung, where they also have reported like 86.1 trillion won in Q3 in 2025 in revenue. Basically, I mean, the operating profit was 12.2 trillion won. Basically, it's the highest in years. Basically, in the HBM and DRAM and NAND, where basically their production plan, well, basically it's kind of the fulfill all their current capacity. And indeed, of course, for the next years, where they basically their orders, especially for the SK Hynix for the DRAM and NAND and HBM is kind of full right now. So basically, they're going to fulfill all this capacity so that they can maximize their profit or revenue until maybe 2026. So in terms of the competitive edge, like Korean semiconductor firms, where they are basically have the segment that AI needs most. So why they want to have those kind of advantage? Well, Samsung and SK Hynix, they control roughly half of the global high bandwidth memory, the HBM market. And SK Hynix, basically alone, they're going to say the high-end HBM3E and DDR5 products are driving profit margins, basically extraordinarily high with the utilization effectively maxed out for the next years. So basically, analysts are going to say, well, for the Q4 in 2024, and SK Hynix, basically, they're going to fully operating profit is going to jump close to 9% year on year. Basically, those two firms, basically, they're going to carry off the cost beat maybe this year and possibly for the next years. Those kind of leadership for the technology in the HBM3 or HBM4 and DM and NAND, basically much color visibility on orders from the US and other global hyperscalers on the rise, that they're going to recognize the Koreans, I mean, the two companies' strengths, and they're not going to have, they're not going to say it's like a bubble, but they're going to say this kind of the competitive advantage for those kind of the two companies, and they're going to establish, or they're going to need it for establishing the infrastructure grade memory in the AI functions.
So despite the noise, the fundamentals still seem quite strong in key sectors. Now, before we conclude, let's also just touch upon trade. Korea and the UK just concluded an updated FTA easing origin rules for key exports such as cars and food. Professor Bae, how might this help Korean exporters and boost competitiveness?
Yes, the Korea-UK FTA upgrade concluded December 15th. Relaxes rules of origin, dropping auto value added threshold from 55% to 25% and easing them for food, processed goods, boosting Korean export by reducing tariffs on EVs, K-food such as kimchi, gimbap, and K-beauty. The main reason for this relaxation are threefold. First, the expiration of the EU cumulative preferential rules. Korean cars from Hyundai and Kia faced losing export eligibility to the UK after the existing FTA's EU provisions expired on December 31 this year. but this deal fixes that. Second, global supply chain crisis. High reliance on Chinese EV batteries and minerals made biddings the 55 value-added threshold impossible, so it drops to 25%, enabling continued export. Third, mutual benefits balance. Korea targets autos and K-food export, while the United Kingdom's eyes finance, gaming, and high-speed rail markets, especially aligning with the post-Brexit UK trade diversification. This relaxation benefit autos, food, and K-beauty industries most. Korea and the UK also expect stronger supply chain resilience through expanded AI and digital cooperation. However, risks include potential KTX tech leakage to the United Kingdom's high-speed rail markets, and moreover, feasibility issues with deregulating Korea's service sectors.
But generally, that could be a timely boost, especially for mid-sized exporters as well. And let's hope for more of these trade agreements in the coming year. Thank you so much for your insights, Professor Bae.
Thank you.
And Professor Kim, for your time tonight. We really appreciate it.
Thank you.
And that'll be all from us on Within the Frame. Be sure to tune in again next time as we continue to explore the stories that matter. Till then, stay informed and engaged.